Welcome back, everybody, to another episode of FinTech Fridays. Super excited to have Bruce Gehrke on with us today. Bruce is with JD Power. JD Power just released the Originations Customer Satisfaction Survey. Is that right, Bruce?
That's correct. For 2024, beginning of November, results went out.
Awesome. Well, Bruce, thanks so much for joining me today.
Great. It's great to be with you, Brian, and look forward to a conversation.
So I reached out. I think we actually traded maybe comments on a LinkedIn post or something initially. And I know one of your colleagues pretty well from my past life in lending. And, I reached out because once the survey came out or the results of the survey came out, it's always fun to watch people comment and make comments. Sometimes their comments are misinformed, and frankly, a lot of times they are. And so I started to see people make comments that were kind of annoying to me. And so I reached out to you and asked you if we could come on here on the podcast and just talk for a little bit about the survey and the results, because I think the results are very interesting and very telling for all of the industry. And it's important, this is a representative survey of consumers who got mortgages from lenders. And so I'd like to start, if it's okay, Bruce, with kind of how the survey process works for you all and how consumers are sampled and selected and participate in the survey.
Sure. First of all, it is a little different look at the consumer base than what most lenders do directly and internally. They do their own surveying. Almost everybody does that these days. What we do is we use independent panel providers, research panel providers, and this study utilizes about 8 or 9 different panel providers across the country. And what we do is we develop a list of the top retail lenders. We use Inside Mortgage Finance for their origination data. We look at that data and we find our internal rules state we need at least 2/3 of the national market to have an effective and a true JD Power study. And so that's what we look for. And we develop a list of lenders from that. We take that list, we send it out to the panel providers. Our screener is a new mortgage, refi, purchase, whatever, first lien that was taken out in the last 12 months. So we're looking only back 12 months. Now we field it throughout the year. That's a little bit different now that we started doing that 2 years ago. So instead of a static period where we field it, we field throughout the year. So that's kind of a rolling look back of about 6 months at each quarter. And then we publish results each quarter to our clients and once a year publicly and give out the award. So what folks do is if they pass the screener and they've gotten a new loan, they look at that list, they choose their lender from that list. If they don't see their lender on that list, they're not shown the survey. So then they get into the survey and they ask those questions. And the difference here is there's no single event, there's no great experience or poor experience motivating why they would take a study. So there's less what we call self-selection bias in the results. It's just a different look. It could be 3 months, 4 months, or 5 months from when they closed. So you don't have that halo effect of when you actually got the money, got into your new home, et cetera, and the excitement that comes from there. Our results tend to be a little more passive then, a little bit more tougher on the lenders than what you get right out of the gate, in that first couple of weeks after you close. And we take those. We have minimum requirements for how much sample requirements we need to make a comfortable and a confident statement on what we think the experience was and how satisfied they are with them. And if they reach that number, then they're shown in that rank chart that we distribute publicly at the annual publish.
So I want to just poke a little bit there, not poke, but drill in a layer deeper. And this is really important, I think, for the audience to recognize. You described the panel process. So, first myth, I guess I'll dispel or will help dispel together is the consumers that are selected for these panels are not selected by the lender. These are selected by the panel partner that you described. And it makes no difference whether a lender is a partner of JD Power or not, whether their consumers fall into your survey, right?
Correct. They're anonymous to us. We don't know who they are. Everything in our study is consumer provided, so including who they got their loan from. So with any consumer surveying. There's some inexact sometimes answers we see and things of that nature. We have lots of questions. We have JD Power's been doing this for over 50 years. So they have a lot of scientific surveying methodologies around trying to ensure that we're getting and we're confident in what we're getting, that it is for the folks that we're surveying and for the right lenders. But lenders don't choose to be in or choose not to be in. It's all driven by market share. We create market share targets based on how large the lender is. So no one lender has an over or outsized impact on the averages and other data in the study. So we could collect a sample from big lenders like Chase or Rocket Mortgage, all day long, but we stop at a certain point.
Yeah.
And to stay within those quotas so that our total sample reflects true market share.
And you said this in the onset, but I just want to make sure the audience recognizes the lenders that ultimately are ranked are typically going to be the top market share producers, just because that's the representative sample of the originations, but they're also direct retail only.
Yes.
There's no third party originations that are captured in the study.
We have some questions to try to identify that. So we asked the consumer to identify who their lender was. We do have a segment that we use specifically with clients that focus on brokered wholesale loans, but that's separate and that's not in the public study, and that's not in the results that we release publicly. We do. Inside Mortgage Finance does make an attempt to split that out based on, I think, the HMDA data that they use or look at. And so we use that. So a large lender, for example, like PennyMac, that's a large, third party, whether it's wholesale or correspondent, will have a smaller market share because their direct consumer business is a little bit smaller than their big overall footprint. So we're looking at retail lenders that consumers recognize as the provider of that experience ultimately.
Yeah. All right. Well, let's shift gears and now let's talk about the big findings that you guys saw in the 2024 survey results. How they're starting to differ from maybe prior years. Anything that was telling for you in the study.
Yeah, I think the major thing that we saw this year was a change in consumer preferences. So we ask a lot of questions and collect data around what a borrower is looking for from the lender. And we've always seen over the last 4 or 5 years that they prefer what we call a hybrid relationship, part digital, but also part personal. And having that drives the highest levels of satisfaction. We've also seen a growing over the last 3 years percentage of borrowers who want a purely digital experience. So that's something that has grown year over year. And we qualify that question, in a second follow-up with assuming that the tools are properly, because there is a question of whether the ability is there. We're seeing that from some lenders, but not broadly across the industry. But if that was the case, we saw that grow to over 50% last year. So there was a large percentage of folks that were saying, yeah, I'd do this all digitally if I could, and if it worked well. We saw that reverse itself this year. So we saw a higher percentage of folks who want that individual personal interaction in there. The number overall has grown to about 92% of all the borrowers who said that. The number of folks that want just the digital only dropped well below 50% for the first time in the last 3 years. So we see that move towards a kind of personal interaction, and other parts of it is what they see the role of the lender. And we saw a greater number of consumers respond that they really feel the lender should take them by the hand, more or less, and walk them through the process, like be there along the way and really help them through the process. And I think what we're seeing is the result of the changes in the market. We are looking back over about 12 months up to about probably 14 or 15 months from the very beginning of the fielding period. And that is the hardcore part of higher interest rates, difficult buying market, fewer refis. We're seeing much more purchase business and purchase customers in this study this year. And we're seeing that experience and the challenges that they've felt there really being reflected in what they expect from a lender. And I think it opens up opportunities for lenders to play that role. And in our results, we're seeing the higher performing brands in the satisfaction side are the ones who are seeming to meet some of those new customer needs.
Yeah, there was a call out in the results that was part of the press release that was near and dear to my heart based on what we do at FinLocker. I this will prove out on how poor of a podcast host I am. I don't have the press release right in front of me, but I know you know it by heart. There was a call out to this desire for consumers to be engaged much earlier in their journey. Can you talk a little bit about that?
Yeah, that was another piece in the data that we saw. So we asked, when they first engaged um, with their lenders, and we saw that the highest percentage grow to when they first started thinking about buying a home. And over the last 2 years, 3 years, that was pretty static. This year, that jumped up to over 42% of all borrowers said they reached out while they were thinking about buying a home. And then it dropped off. And the lowest number was more in that traditional time frame where I found a home, I've got an approved offer, and I'm looking for financing. And then we took those groups and that split, and we looked at all the other metrics, not just satisfaction, but advocacy. We ask about the ability to, or the desire to refer your lender to others, your willingness to come back for the next loan, to stay with them for a refi. And all those numbers were significantly higher across the board for that group that reached out earlier. So it shows that opportunity that we think the market, because of the nature of what's going on with interest rates and the real estate market, it's more of an advisory focused customer is what they're looking for versus a transaction. And that transaction, you had transactors who did great jobs in turning loans fast, getting people refied at low interest rates and getting on to the next. And that was an advantage. We've seen that business sort of dry up quite a bit. And now we're seeing, those folks who can be advisory, who can work with people through the process, who can help them, navigate a more difficult time. And they're getting the benefit of not just higher satisfaction, but also greater advocacy. And there's a much lower likelihood of those borrowers to shop around more, to submit a second application with somebody else. They're more loyal to that initial outreach than other folks who are reaching out later in the process.
Yeah, I thought that was a particularly fascinating call out. And then as I've had time to kind of digest it and think about it, all the things that you have talked about in terms of, the shift in the market, more purchase, less refi, higher rates, you can throw on, inventory challenges and affordability and all that stuff. Really what the survey speaks to is the entire mortgage community, whether you're on the list or not, based on the size of your company. This is a blueprint for how to meet the needs of the consumer. They're telling us through these surveys what they want and how they'll reward those that provide these things. And I just thought it was fascinating that particular piece got pulled out in the survey. Was there anything else that you saw that was maybe kind of not a head scratcher, but a little bit of an aha moment in the data?
No, it changed a little bit. So if you looked at our 23 study, one of the big differences overall is I think it was 72% of all the brands in the study were up year over year for satisfaction, and some significantly, but there was such a swing. The industry average satisfaction was up 14 points. So you had this sort of reaction to lower interest rates, faster loans, turnaround. Things are going great. This is good. Then all of a sudden this year's study was heavily into that higher interest rate market. People volumes dropped. You had staffing changes. You had a lot of instability there for a while with people who are in the process. And we saw a significant drop off in satisfaction early in the process. So about a year or so ago, last summer into last fall. But since then, there's been a steady build up back up to where we were prior to. So it's interesting to see. And I think this speaks well for the industry as a whole, that they've adapted. They've right sized their staffs, they're focused on the customer, and they're delivering for the customer. And what we're seeing across the board is the nuts and bolts of lending is being done really well. Technology investments are paying dividends. They're making things more efficient, more easy, quicker through the process. But it's really those folks that are taking that and taking the customer and putting them together, and considering both sides of that. So it's not just providing a great journey, it's guiding that journey as well as providing it. So the differentiation is happening there. And I think that's really the big thing that jumps out this year is as you see the difference there.
Yeah, I think again from my seat, looking at this, it speaks to me of the importance of the individual loan officer, right? The person, because it let's be honest, when the consumer is talking about the company, especially in the context of this engagement that's happening much earlier in the process, it's really the person, and that person's typically going to be the loan officer who's actively engaged. And it just speaks to how important that role, the role of a loan officer, is in this business, especially in the purchase business, where it's not as cut and dry and cookie cutter as it would be in a rate and term, streamlined refi transaction.
Yeah, the other thing, sort of individually, we ask questions about the process, and we've seen some of the changes. We saw some risk-based changes in underwriting, if you go back and some of that's reflected into some of the data around documents required to get approved, asking for documents more than once, things of that nature. And there's definitely some wobble in the data there for the industry. And I think it's just reflective of what's going on out there. But yeah, to your point, it's exactly what we're seeing. And those folks that there's interesting things that we see too across the business model. Some direct to consumer lenders have kind of cracked that code a little bit, and they're doing, I'd say, playing sort of overachieving in this type of market because they're making that personal connection. So it's not that it's impossible. It's not that you have to have that loan officer out on the street. It certainly helps in this environment. But there's some folks that are doing some good work that don't have that model. So it's interesting to see how the industry is adapting.
What would be really interesting in future surveys is asking the consumer, hey, did you ever meet your loan officer face to face? Not on a screen like we're doing right now, but literally belly to belly. And then if they said yes, how many times during the process did you meet? I believe that why we're starting to see more of the consumer directs show up more often, even in the purchase side, is because we're all doing business this way already, and we're accustomed to it. And I think those really good shops that are good business minded, operators understand in order to compete and purchase, you have to have a very personal, high touch experience, which, by the way, can happen digitally, through a screen and in various ways.
Yeah, we do actually ask that. We don't ask, I have to take that under advisement about the number of times, but we do ask about, did you want to connect personally and did you
Yeah.
face to face? And then we do ask about other methods. And we've seen, it's interesting, and it's a small number because not a lot of guys do this, but this environment, video conferencing, scores really, really highly for folks that do that who aren't there. And it's a great point because so much of our lives now is done this way. So I think it's somebody, there's a comfort level out there with.
Yeah, I mean, I talk a lot about, the value of and I always air quote it, a local loan officer. When I define a local loan officer, I'm really defining a loan officer that leads with education and is willing to play the long game with a consumer and is not just waiting for someone to raise their hand and say, I'm ready now. So it's been really interesting to watch kind of this everything morph and change. And it goes back to what you described at the onset, that the consumer survey this time really told us that this hybrid approach is what consumers at large want. Last question on the results, and then I want to go in a different direction. Do you ask specifically if this was the first purchase, like a first-time home buyer? Do you identify
Yes.
first-time home buyer?
Yes, we do. The first time home buyer group has higher satisfaction than repeat buyers in this year's study. So I think, and we have a lot of demographic data too on generations and things like that. And the other thing we're looking at is financial health. So we started including that in all of our financial services studies. And it's interesting how that's changed. Because if you think about a mortgage, there's this very intensive qualifying process. So it's like you're not going to get too many people who are financially challenged buying a home, you wouldn't think. But the percentages of people who meet that definition and they don't choose it, they answer questions, and that determines those characteristics. But it's higher than it has been. It's gone up. Well, it didn't go up so much last year on the purchase side, definitely on the servicing side, but it's even higher on the purchasing side now. So you're seeing the impact of the overall economy and what inflation did to folks, in this process. And that's another factor that makes it a little more complicated.
Okay, now I want to, for the last part of our talk, this will help dispel, the misinformation, the myths, if you will, that the survey is a pay to play type of thing. So you all do have paying clients and paying clients who are lenders, but let's talk about what that really means. Like, what are they really buying from JD Power when they become a client?
Well, first of all, they get access to all the data. So this year's origination, I think we had 7,500 completed responses. So from all the lenders, so they see everybody's, not just their own, but everybody's data. So they get that. We have tools that they can use to slice and dice the data any way they want. They get access to our team to help them understand how we view it, and we're the ones who design it, obviously. So we know what we're trying to get to. So really the heart of what we do is we work with folks and trying to identify based on what they're looking for, what they're interested in, why they actually want to engage with us, what are they trying to find out, and if we're aligned there, then we're trying to mine the data with them and to help them achieve those goals. So if it's they're considering investments in certain areas of the process, and one of the inputs they want to put, they want to consider is the impact on the experience and satisfaction. This is a good way to look at what that means. And it's another thing to consider when you're trying to prioritize budgets and things of that nature. The other thing is just driving a better experience and meeting that customer where they are. And sometimes we can help them see things in their own customer base that they're not seeing, because they take their data and combine it with our data and they get a more fuller picture. They do get a sense of how this is all comes together. In a way, it's like an SAT prep course. It's like the idea is you're going to do better on the test as you go down, because you start to address those issues that really impact the way we service this. So there is some output on that, but believe me, it is not, it's not ABC and you get D. There are lots of intangibles in there, but the general focus and the folks that work really well together, that we work well together, are those who are looking to improve the efficiency of the journey, of the customer journey, and that experience for them. And eventually that does translate into higher satisfaction, and you'll see that in the results. And if they're not, then, we're not doing our job. So, we're trying to identify those opportunities to improve, those places where they're going strong and they may want to double down and continue that. And they also use it as a way to get competitive intelligence, to see what other folks are doing well, who's best in class at a certain part of the experience or a different aspect. And then they can go off and try to figure out what they're doing, to get that respect. Obviously, we respect everyone's confidentiality, so we don't share any of our conversations with clients, but they do get access to everybody's data. It's an open data set. It's ours. We don't ask them for their customer lists or anything like that. So that's the basic. It's a performance improvement engagement at the end of the day.
Yeah, I mentioned this at the onset. In my past life, I was at a company that we partnered with JD, and I was at a bank. It's our partnership at the bank started outside of mortgage, started in the consumer bank, and we brought JD Power into the mortgage business, and then I believe they also brought you guys into servicing. And I recall, a lot of anxiety in those initial readouts because we weren't perfect, and we knew where we thought we knew where we were short and needed to, kind of shore things up, so to speak. And I always found the engagements to be super enlightening and helpful. And we actually did some things back in the day to align compensation for originators with not necessarily the scores, but the things that were identified in the scores that we believed if we did better, and by extension, if the loan officers did better, we would show out better. And so it's not an overnight process. It's a fluid process. But I always found that the access to the data and the people at JD Power was extremely helpful and made our business better, frankly.
Yeah, one of the things I think is context. So what you tend to see internally is, and we hear this all the time, and they're like, "Well, you say we're only here, and that's average, and yet look at our results." They say, we got 9 out of 10s on all these, 5-star reviews, and all the rest of this stuff. And sometimes you can lose sight of what good really is because you don't have context outside of your own organization. So what seems to be coming back and looks great, but compare that to the guy down the street or another competitor, and it's different. And so that's one of the things when I talk about combining our data with internal data really completes the picture because it brings in that extra level of context because it is comparative across those brands, in the same way the questions are asked the same way and the same thing, and so you can look at that and you can see where you stand and then get a better definition of what really good is. And that we find that some of our clients find that very helpful.
Bruce, this has been a lot of fun for me to kind of revisit my origination days, and I appreciate all the great work that your team does at JD Power. Thanks for coming on and sharing kind of more details on the survey, but also dispelling some of the misinformation that's out there around JD Power. Thanks again for joining me.
Well, thank you. Love the opportunity. Really appreciate the opportunity to talk about it. And thanks for having me.
We'll be back in 2 weeks, guys, for the next episode of FinTech Fridays. Until then, enjoy your next 2 weeks. See y'all.